Welcome to Breaking News to Trading Moves. So today we are looking at some text concerning the AI pivot, specifically outlining the software market winners and losers right now.
Yeah, it is a very grounded look at what is actually happening with enterprise budgets.
Right. No world-changing predictions here, just a practical review of the recent headlines and who is benefiting. And to set the stage for you listening, we need to start with the facts from Salesforce's first quarter.
Because that Q1 report really lays out the baseline for the whole discussion.
Exactly. So Salesforce actually had a stronger than expected first quarter. Revenue came in at $11.13 billion, and adjusted earnings were $3.88 per share.
Which is a very solid beat, and their subscription and support revenue grew by 14%.
Yeah, and they even added 98 new deals, with each of those being worth more than $1 million in annual contract value. So, looking at those numbers, it paints a picture of very solid execution.
It really does.
But here's the question for you to consider. If those first quarter numbers were that strong, why are traders so entirely focused on what comes next?
Well, that tension is the central narrative in the market right now. You look at a strong first quarter, but traders always trade on the future.
Always.
So when we move from that Q1 success to the Q2 hesitation, we find this core debate happening regarding the mechanics of the software market itself.
Because the Q2 guidance is where things got a bit muddy, right?
Right. The Q2 revenue guidance Salesforce provided is $11.27 billion to $11.35 billion. And that forecast is just slightly below market expectations.
A very slight miss.
Yeah, but that slight miss opens up a much broader conversation about the underlying business model moving forward.
Which brings us to the per-seat dilemma. Think about it like this. Imagine buying an individual buffet ticket for every single employee in your company.
Which gets expensive fast.
Right. But then you realize one highly efficient robot could just walk into the restaurant and grab all the food for everyone. You wouldn't need to buy those 50 individual tickets anymore.
And that scenario is exactly what traditional software executives are losing sleep over right now.
So traders are asking, will AI agents help traditional software companies grow, or will they reduce the need for those per-seat software tools?
Because for decades, the software as a service model, or SaaS, has been built entirely on headcount. You hire a new employee, you buy a new software license for them. It is a strict one-to-one relationship.
But now Salesforce wants Agentforce to be a major growth driver.
Yeah.
They're trying to sell you that highly efficient robot.
Exactly.
But if I'm a business owner and this robot can do the work of 10 junior sales reps, I'm going to cancel 10 software licenses.
Yeah.
So how does selling one robot make up for the lost revenue of 10 human licenses?
Well, the market is demanding proof that it actually can. Traders want to see that selling this new automated capability will bring in more money, or at least the same amount of money at a higher margin.
Higher margins would help offset the lost volume.
Right. But they need proof that it offsets what the company loses if customers decide they no longer need as many individual human licenses. The market does not want to see the old SaaS model weakened without a clear, measurable replacement for that revenue.
Because right now, we are talking about replacing a highly predictable revenue stream with something that is just entirely untested.
Completely untested at scale, yes.
So if Salesforce and other traditional software companies are worried about selling fewer seats, the obvious question is, where is that software budget actually going? The money does not just disappear.
No, it doesn't. It is flowing directly into the physical hardware that makes these AI agents possible.
Which brings us to the first group of identified winners here, AI infrastructure.
Right, because regardless of how the software companies figure out their billing models, the physical reality is that more AI usage means a direct, immediate increase in demand for hardware.
You cannot run this stuff on a standard laptop.
Not at all. If more software companies keep adding AI agents and copilots and automation features, all of those tools require immense computational power. They require graphic processing units, custom chips, and highly advanced networking equipment.
So we should list the beneficiaries clearly for you. In this space, the main name tied to large-scale AI workloads is Nvidia. But it's not just them. You also have AMD, Advanced Micro Devices.
Let us pause on AMD for a moment because understanding their role requires looking at the broader ecosystem. Nvidia is obviously the dominant player.
Oh, absolutely.
But the demand for these graphic processing units, or GPUs, is so intense that companies just cannot get enough of them. They are constantly looking for accelerator supply.
And an accelerator is basically a specialized piece of hardware designed to speed up the specific math required for AI models, unlike a standard central processing unit that handles just general computing.
Precisely. And AMD provides a highly capable alternative in that accelerator market.
And then there is AVGO, Broadcom, which has exposure through custom AI chips and networking demand. I really want to emphasize that networking aspect because it is something traders watch closely.
It is arguably just as crucial as the processor.
Right, because you can have thousands of the fastest GPUs in the world, but if they cannot pass data back and forth to each other instantly, the whole system just bottlenecks. Broadcom provides the networking technology that prevents those traffic jams.
Yeah, and once you have the chips and the network, you need a physical location to house them, power them, and keep them cool.
Right, they don't just sit on a desk.
No, which leads us directly to the cloud platforms. AI agents need massive amounts of storage. They need complex databases, robust security, model hosting environments, and vast amounts of cloud compute. These models live in massive, power-hungry server farms.
So they need an ecosystem to live in.
Yeah.
And that directly benefits the hyperscalers. And when we say hyperscalers, we are talking about the massive cloud service providers.
The big three, basically.
Right. For the cloud platforms, the identified winners are MSFT, Microsoft exposed through Azure, Microsoft 365, and enterprise AI adoption. Then there is AMZN, Amazon benefiting through AWS workloads linked to AI and data-heavy applications, and GOGL, Alphabet gaining exposure through Google Cloud.
As enterprise software companies push further into AI, they just have to rent more space and power from these hyperscalers. It is a straightforward flow of capital.
The software companies are trying to build the tools, but to build and run them, they must pay the infrastructure and cloud providers.
Exactly. The hyperscalers charge for the compute time. Every single time an AI agent processes a complex query, the cloud provider makes money. That is why traders have identified them as clear winners in this environment.
So we are moving up the technology stack now. We know who is making the chips, and we know who hosts the AI on the cloud. Now we need to look at which software companies are actually succeeding in utilizing it right now. This brings us to our next group of winners, the automation software companies.
And the market is strictly separating software businesses that only talk about AI from those that can actually show real productivity gains.
Right, real automation value. Because I feel like almost every technology company mentions artificial intelligence in their press releases right now.
Oh, yeah. It is everywhere. But investors are looking for businesses that integrate it into actual functioning workflows that save their clients time and money immediately.
So let us list the companies succeeding here.
Yeah.
We have NowW, ServiceNow, which is linked directly to workflow automation, PLTR, Palantir, focused on data integration, and ORCL, Oracle, benefiting from database demand.
Those are the standouts right now.
But wait, let me push back on this a bit. Every single earnings call I listen to mentions AI integration.
Yeah.
It is just the buzzword of the year. How is a trader actually supposed to separate a glorified chat window from a tool that genuinely saves a company money?
It really comes down to utility versus novelty. Talking about it usually means just adding a basic text generator to your software.
Like a feature that just summarizes an email.
Yeah, which is helpful, sure, but it does not alter how the business operates. Proving automation value means the software can take a complex multi-step process and execute it without human intervention. ServiceNow, for example, is built entirely on managing IT workflows.
Give me a concrete scenario of how that works in practice, like day-to-day.
Okay, so imagine an employee's laptop breaks. Historically, there is a whole multi-step process. The employee fills out a ticket, a junior IT person reads it, routes it to a manager for hardware approval, the manager approves it, it goes to procurement, procurement orders the laptop, and shipping sends it.
That is like 5 different people touching one ticket.
Exactly. But if an AI agent can read the initial complaint, verify the employee's hardware budget, automatically approve the purchase order, and ping the vendor for shipping, all without a single human clicking an approval button, that is real workflow integration.
Wow, yeah, that just completely removes friction and labor costs.
It does, and that is what investors want to see.
That makes perfect sense. And how does Palantir fit into that standard?
Well, Palantir tackles the silo problem.
Yeah.
Large corporations often have logistics software that does not talk to their inventory software, which doesn't talk to their finance software.
Oh, the data is all walled off.
Yeah. Palantir takes massive, disparate data sets and integrates them into one unified view. So an AI model is not just looking at a fraction of the business, it can actually make operational decisions based on the entire supply chain.
That is tangible value. And that is what attracts investor attention over just simple chat features.
Absolutely.
So knowing that true automation is the key to winning, We have to return to the companies directly threatened by that very same automation. The companies currently caught in the crosshairs, starting with traditional seat-based SaaS.
And this group faces direct pressure because of everything we just outlined regarding those workflow examples. Investors are actively questioning the durability of per-user software pricing.
Because if you think about the daily operations of a large corporation, you have sales tasks, marketing workflows, customer service responses, creative work, routine finance tasks.
And historically, you needed a human employee for every step of those workflows, and each human needed a software license.
But if AI agents can automate those tasks, customers will inevitably rethink how many seats they actually need to purchase.
Right. If the AI agent is drafting the sales emails, you do not need as many entry-level sales development reps. If the AI is handling the initial tier of customer service responses, you do not need as many call center agents.
And the companies watched closely in this category include CRM, Salesforce, which is actively navigating this transition right now. Then there is ADBE, Adobe, facing questions around how AI alters creative workflows.
Right, because if generative tools can create commercial graphics instantly, agencies might employ fewer junior designers.
Which translates directly to fewer creative software licenses sold. And then WDA, Workday, is watched closely because human resources and finance software could face pressure if administrative headcounts shrink.
Makes sense. Fewer employees at a company just means fewer HR profiles to manage in the system.
Exactly.
But the pressure extends beyond just the traditional SaaS companies. There is a related group at risk, cloud software with valuation risk. The specific tickers mentioned here are SNOW, Snowflake, DDOG, Datadog, and MDB, MongoDB.
And these often trade as part of a wider software basket, meaning if sentiment turns negative on software spending, they can all face downward pressure together. But I want to explore why their budgets are getting squeezed in the first place.
Well, in a market where buyers are focusing their spending only on platforms with the clearest, undeniable AI value, investors become much more selective. High-growth cloud software names often trade at very high valuations based on the expectation of consistent, aggressive growth.
The price assumes companies will just keep expanding their IT budgets and buying more software forever.
Exactly. But IT budgets are a zero-sum game. If a chief information officer has a set budget for the year and they suddenly decide they need to spend $10 million on Nvidia hardware or renting Microsoft Azure compute power to run their new AI initiatives,
They have to cut that $10 million from somewhere else.
that is the mechanical reality traders are watching. The budget is flowing to infrastructure. That means these expensive software stocks may face tougher questions regarding their growth rates, their profit margins, and overall corporate software budgets.
And companies like Datadog provide observability, right? They monitor how well your cloud applications are running. Snowflake is a data warehouse. They're excellent companies with strong products.
Very strong products. But if a client is scrutinizing their budget to pay for AI compute, they might decide to store less data this quarter or dial down their observability metrics to save cash.
So the current market environment makes their high valuations a point of vulnerability.
Yes. If the overall budget pool is shrinking or being redirected, these companies have to fight much harder for every dollar of expansion revenue from their existing clients.
Okay, so the impact of this technology is not just on the software itself, but on humans hired to implement it. That brings us to our final group of identified losers: IT services and consulting.
And the central issue here is the billable hour problem. For a very long time, implementing enterprise software was incredibly difficult.
Oh, it was a nightmare.
Right. If a large corporation bought a new software system, they rarely installed it themselves. They had to hire a consulting firm to come in, customize the software, integrate it with their legacy systems, train the staff, and maintain the code.
And the consulting firm would charge by the hour for every single consultant on the project. It was a very manual, labor-intensive process. You'd have a small army of junior consultants billing 40 hours a week for months on end.
Highly labor-intensive. But AI agents could pressure this part of the technology services industry if the software itself becomes much easier to customize and support using AI.
Like if the software can essentially configure itself based on natural language commands.
Exactly. Then clients simply need fewer billable hours for that basic foundational work. Instead of hiring a team of 5 people to write custom integration scripts for 6 weeks, an internal IT manager might just ask the AI agent to write and deploy the script in an afternoon.
And the companies identified here are ACN, Accenture, EPAM Systems, and CTSH, Cognizant. But I want to pause on a caveat from the material here. These companies might still benefit from large AI projects. I mean, every Fortune 500 board of directors is demanding a custom AI strategy right now.
That is true.
So how do traders weigh those massive new AI implementation projects against the potential loss of basic billable hours?
That tension is the core of the debate for these stocks. On one hand, you have those bespoke, high-margin projects. Building a proprietary, secure AI model for a global bank is incredibly complex, and firms like Accenture are exactly who you hire to manage that risk.
Those are massive, lucrative contracts.
They are. But on the other hand, the routine maintenance, the basic code testing, the standard software integration, all the bread and butter work that kept those thousands of junior consultants billing hours every week.
That work is highly susceptible to automation.
Right. So traders are trying to model whether the revenue from the new, complex AI projects is enough to replace the lost revenue from a reduction in overall headcount-driven billable hours.
It is a race to see if the new high-end work outpaces the erosion of the low-end work.
And right now, the market is approaching that race with caution, categorizing these firms as potential losers until they prove the math actually works in their favor. The volume of low-level work has historically provided a massive revenue base for these firms.
Well, let us briefly recap the journey we just took. We started with Salesforce's solid earnings and Q2 guidance, which revealed a broader divide in the market regarding per-seat pricing. We looked at the infrastructure winners, the hardware and cloud providers physically powering the technology, from Nvidia to the hyperscalers.
And then the software winners actually proving productivity gains.
Right, automation companies like ServiceNow and Palantir. And finally, we examined the stocks traders are actively pricing down, the seat-based losers, the high-valuation cloud stocks facing budget squeezes, and the consulting firms facing pressure as automation alters how businesses buy and implement technology.
It is a very clear dividing line when you lay it all out.
It really is. And before we finish, I want to leave you with a final thought to explore on your own. As these AI tools become highly capable agents that can operate independently within a network, will the technology industry eventually have to redefine what a user actually is?
That is a great question.
And as a result, how will enterprise software companies figure out how to bill for a non-human user that works 24 hours a day, executes complex workflows, and never takes a vacation? Make sure to remember this is not financial advice or buy or sell recommendations. This is purely the opinion of the author.